How much money do you really need to buy your first rental? One of the biggest reasons people never invest in real estate is because they think they need a fortune to get started. Maybe you've heard that you need $100,000 in the bank before you can buy a rental property. The truth? That's simply not true for many investors. Today, I'm going to break down the most common financing options, how much cash they typically require, and how you can create a plan to buy your first investment property. By the end of this video, you'll have a roadmap to determine which strategy could work best for you. The biggest myth about investing. Let's clear up the biggest misconception first. People often confuse buying an investment property with buying any property. In reality, there are multiple ways to purchase real estate, and each comes with different cash requirements. Some investors put down 20%. Some use owner-occupied financing. Some buy duplexes and live in one side. Others use specialty investment loans. So instead of asking, "How much money do I need?" the better question is, "Which investing strategy fits my financial situation?" That's the question successful investors ask. Understanding your financing options. Let's compare the most common financing options. FHA loan. If you're willing to live in the property, an FHA loan can require as little as 3.5% down. Many investors buy a duplex, triplex, or fourplex using this strategy. They live in one unit and rent out the others. This is commonly known as house hacking. Your tenants may help cover a significant portion of the monthly mortgage. It's one of the fastest ways to get started with limited cash. Conventional investment loan. If you're purchasing a rental property strictly as an investment, lenders often require around 20% down. Why? Because investment properties generally carry more risk than owner-occupied homes. The larger down payment helps reduce that risk. DSCR loans. Another option that's become increasingly popular is the debt service coverage ratio loan, often called a DSCR loan. Instead of focusing primarily on your personal income, these loans place significant emphasis on whether the property's rental income can support the mortgage payment. For self-employed investors or business owners, this can be an attractive financing option. What does 20% actually look like? Let's make this real. Suppose you're buying a $200,000 rental property. A 20% down payment would be approximately $40,000. A $300,000 property would require around $60,000. And a $400,000 property would require roughly $80,000. But here's something many first-time investors overlook. The down payment is only part of the equation. Hidden costs first-time investors forget. You should also budget for several additional expenses. Closing costs. Home inspection. Appraisal. Insurance. Potential repairs. Utilities while the property is vacant. Emergency reserves. One unexpected roof replacement or HVAC repair can cost several $1,000s. That's why experienced investors don't spend every dollar they have just to close the deal. They leave themselves room for the unexpected. How to save faster for your first property. So how do you actually reach your investment goal faster? Here are 5 practical strategies. Number 1. Open a separate savings account dedicated only to your future investment property. Seeing that balance grow creates momentum. Number 2. Pay down high-interest consumer debt. Lower monthly obligations can improve your borrowing power. Number 3. Consider house hacking. Living in one unit while renting the others can dramatically reduce your housing costs. Number 4. Research markets where homes are more affordable. You don't have to invest in the city where you live. Sometimes the best opportunities are in nearby communities with stronger cash flow. And finally, have a written plan. Set a target purchase price. Estimate your down payment. Determine how much you'll save each month. Investors who write down their goals are far more likely to achieve them. The real question isn't can I? After speaking with many investors over the years, I've noticed something. The people who succeed aren't necessarily the ones with the most money. They're the ones who start with a clear plan. They educate themselves. They run the numbers. They stay disciplined. And when the right opportunity comes along, they're ready. The bottom line. So, how much money do you really need to buy your first rental property? The answer depends on the financing strategy you choose. But for many people, it's far less than they imagined. Don't let the idea of needing a fortune keep you from learning what's actually possible. In our next episode, we're going to answer another important question. What is the best type of rental property for a first-time investor? Should you buy a single-family home, a duplex, a fourplex, or jump into multifamily investing? We'll compare the pros and cons of each so you can make an informed decision. If this video helped you, please give it a thumbs up, subscribe to New Day Property Redevelopers channel, and share it with someone who's been thinking about investing in real estate. Thanks for watching, and I'll see you in the next episode.